everybody, and welcome to this weekly Blitzinar for week 8. My name is Abhishek Gupta. I'm the head of product at Scientific Info and Private Assets. And today's topic is 2024 year in review. We are going to look at the performance of private equities and infrastructure in 2024. And today we also have a guest speaker, Gianluca Minella, with us. He's the head of research at Infrared Capital. So we would like to hear his comments as well from the experience of a fund manager, that what the performance of infrastructure was, where the opportunities might be in 2025, and their feedback from working with LPs. If you have been attending these Blitzinars, the format will look familiar to you. We will have a 15-minute presentation of the paper or report. In this case, we are going to look at the performance overall for the year. Then a few minutes for Gianluca to provide his comments, and then towards the end we'll leave the floor open for any Q&A. So for questions, you can just raise your hand in Zoom, and we'll allow you to talk and ask any questions that you have. And if you have any other questions that we can't cover today, please reach out to us offline. We'll be happy to answer them. So, like I said, all these quarterly index reports that we publish are available on our website. The last ones for December were published on 7th of February, a couple of weeks ago. They provide a snapshot of the performance of flagship indices, and they also delve into much deeper analysis of risk, return, and the drivers of market prices. So I encourage you to look at these reports. Right. In terms of 2024, there are a few key points that I wanted to summarize that we are going to cover in this presentation. First, if you're not familiar with the indices, I wanted to remind you that private metrics indices are asset level. So they are constructed bottom up by looking at individual companies, whether it's private equities or infrastructure equity. We look at the performance of individual companies and then construct the indices in a bottom up manner. The valuations are mark to market using observed transactions and a robust factor model. So as a result, we get a very good idea of where the market is at, what's the performance of different asset classes, and not just return, but also a risk measure for these asset classes, which allows us to measure it and compare it with stocks, for example. And we will do that in this presentation. In 2024, the high-level figures suggest that private equities and infrastructure equity had lower performance as compared to stock market. We will show you this comparison. But infrastructure debt actually outperformed public investment-grade bonds. That's a very interesting finding, and we'll get into more details on this. Then on individual asset classes, private equities, we saw valuation multiples fell in the first half, but they recovered in the second half of the year. In private infrastructure equity, we saw that higher interest rates raised infrastructure equity costs by 50 basis points on average, and risk premia also increased by about 12 basis points throughout the year. In infrastructure debt, although yields increased, but we saw that the spreads have narrowed, and also credit risk improved in 2024. Now, these are some of the headline points that I want you to remember. Now, getting into more details. So here we are comparing, on the left chart, we have Private 2000 Index. That's a flagship global index for private equities. Infra 300 Index, that's our flagship index for infrastructure equity, compared against MSCI World, again, a global index in stock market. And on the right-hand chart, we have Infra 300 Debt, that's our flagship infrastructure debt index, compared against FTSE World Broad Investment Grade Index. In terms of the 2024 performance, we can see that MSCI World actually had a very high performance, 18% return for the year. And in comparison, Private 2000 Infra 300 were much lower. I would say Infra 300 was more in line with the historical average, if you see, 5-year return, 10-year return. So it was more in line with that. But particularly Private 2000 had much lower performance. Infra 300 debt, on the other hand, recovered much strongly this year. After the shocks of interest rates and macroeconomic environment in 2022 and 2023, the year was the index ended the year at 3.36%. So very strong performance as compared to the public investment grade bonds. I also wanted to highlight the risk figures. So first, if you see on a shorter term basis, 5-year horizon, 5-year period, the MSCI stock index had a 17.5% volatility as compared to 15.15 in private 2000 and 10.23 in infra 300. So much lower volatility in private markets as compared to stock markets. But that's more in the shorter term period. If you look at a 10-year period, private 2000 at least is much more volatile than stock markets. So it gives us two conclusions here. One, it's not that private markets are without risk. There is definitely a significant risk in private markets. And second, if you compare, period on period, then the risk is more or less in line with public markets. It's not that they are much less riskier than stock markets. Now we are going to look at individual asset classes and get into more details. So in private equities, in 2024, this chart shows the performance of each sector within private 2000 index and how that sector performed throughout the year. So we are going quarter by quarter, and it goes from lighter to darker as lower to higher returns, right? So the first conclusion we had was information and communication sector. It performed poorly in the first half of 2024. We see AC05 is information and communication, and it was in the bottom half for the first half of the year. But in Q3 specifically, it was one of the top performers. So it swung to the top performing sectors within private equities. Healthcare has been a relatively underperforming activity, particularly in Q4. We see that healthcare was the bottom performer sector in 2024. And education sector is again one that stands out. It's been better than average performer in the first half of 2024. So that's something notable as we compare the sectors within private equities. Next, we wanted to show performance contribution. So to private 2000 index, how different PEX pillars, PEX segments are contributing to the performance. PEX is the taxonomy which defines private companies into revenue model, life cycle phase, customer model, and there are a few other pillars as well. But if you look at these three pillars in particular, we find that the production model-based businesses, as opposed to advertising, subscription, or reselling, production-based businesses were the top contributors of performance to private 2000. In terms of life cycle phase, we saw that mature businesses were the major contributors to performance of private 2000 index. And they're also, we looked at the B2B type businesses, so business-focused companies, they contributed a lot more to private 2000 performance. And finally, in private equities, I wanted to show you the multiples, because in the end, everybody likes to compare against multiples and see how they are doing, etc. So EV/EBITDA ratio and price to sales ratio of private 2000 index, there's a clear pattern. In the first half of the year, the multiples declined, but they recovered at least to some extent in the second half. And if you also do this comparison with public equities, we find that these multiples still are much lower as opposed to the stock markets. So 14.25 as of the end of 2024 for private equities and 17.72 for public equities EV/EBITDA multiple. Right, so those were the highlights for private equities. Now, if we look at infrastructure equity, first is the performance contribution exercise. Similar to what we did in private equities, we split the performance by sectors, by business model, and by corporate structure. And we find that in 2024, renewable power was one of the top contributors to the Infra 300 index performance. It has recovered well in 2024. And besides renewable power, we also saw that the contracted businesses contributed almost half of, actually more than half of the Infra 300 index performance. And so did project finance companies. They had 5.50% return contribution out of 7.85. So strong performance from renewable power, contracted, and project finance companies in 2024. Next, I wanted to show you cost of equity and risk premium analysis. So if you look at cost of equity, we found that throughout the year, cost of equity increased by 50 basis points, most of it coming from the last quarter of the year. And risk premium increased by 23 basis points, again, most of it coming from the last quarter of the year. And why last quarter? Because we saw that the interest rates actually increased in the last year, and that triggered a lot of volatility in the markets again, leading to a much higher increase in cost of equity overall. In total, we find that the cost of equity increase of 50 basis points lowered the market prices by approximately 3.2% on average. So a big significance in terms of the returns for Infra 300 index. Then we can also isolate what drove the risk premium in 2024. So here we are looking at the factor attribution in the last quarter, because that was the major contributor to the increase in risk premium. And we found that leverage was the most influential factor. It increased the risk premium alone by 14 basis points as opposed to other factors. So it's also clear that with higher interest rates, the companies which are more levered, they are being perceived as riskier, and their risk premium is also much higher as opposed to less levered companies, particularly in the current macroeconomic environment. Finally, I wanted to have a few slides on infrastructure debt. Comparing yields and spreads in infra debt, we found that the yields, first of all, increased by 23 basis points throughout the year. They were a bit lower in the first 3 quarters, but particularly in the last quarter, they jumped quite sharply and ended the year at 23 basis points higher. The credit spreads, on the other hand, they decreased by 12 basis points throughout the year, even though they increased marginally in the fourth quarter. That again shows the impact of interest rates, because the last quarter is the outlier. If you look at the performance for the year, they increased quite a lot in the last quarter, and that also led to higher yields. We also measure credit risk in Infra 300 debt. So the left chart here shows the credit spreads within Infra 300 index, but by credit risk buckets, how they have changed from December 2023 to December 2024. And we find that the credit spreads declined across all risk categories. If you see the credit spreads, they've become lower as compared to December 2023 versus 2024. The spreads have declined, but the largest reduction was in the high risk bucket. So they went from 310 basis points to 284 basis points, about 26 basis points throughout the year. Then in the right chart, we are comparing the transition matrix of credit risk, how low risk companies moved from low to high credit risk throughout the year. And we found was that 97% of the companies which were low risk at the start of the year, they stayed low risk at the end of the year. Similarly, 89% for medium and 100% for high risk. The most notable thing was about 10% of the companies which were medium risk category at the start of the year, they moved to lower risk category at the end of the year. So that means the credit risk overall reduced in the infrastructure universe that we track, and that was a significant finding in infrastructure debt. Right. So those were the highlights of these reports and the performance in the year. So just to summarize quickly, we saw that private equities overall had a mediocre performance in 2024 when we compared it to stocks, while infrastructure performance was more in line with their historical average, thereabouts 8% for the year. Private equities and infrastructure, we saw that there was significant volatility if you look at 5-year or 10-year standard deviation of returns, and that was almost in line with public markets, even though in the shorter period, the risk seems to be lower than public in private equities as opposed to public stocks. These indices benchmarks allow investors to measure market risk and return. That's the benefit, because then you can have a transparent view of the asset classes, how the performance has been, and you can use them for these key use cases that we have highlighted: manager selection, benchmarking, allocation, and risk reporting, etc. If you want to have a look at these reports, there's a URL that we can share it later on in the slides, but you can also use this QR code if you want to look at these reports that are available on the website. Right. So that was a quick overview of the performance. And now I'll invite Gianluca to provide his comments on the performance as well. Gianluca.
Thank you so much, Abhishek. Very timely presentation. I have taken some notes as you were going through it, because a lot of the observations that you have made do actually match with what we are seeing in the market at the moment. I'll try to summarize perhaps two or three key points and key conclusions that we can draw from your presentation and an observation of the market. First of all, you clearly see the divide between what is happening on the listed markets, where we still see a
Hmm.
risk-on environment. And I would say
Definitely.
uh, two factors that we can consider on the private markets. The first one, the underperformance compared to the
Hmm.
strong historical performance, which does
Yeah.
raise doubt and some caution with many investors at the moment on the private side, but also the
Mm.
higher level of diligence that we're seeing somehow
Hmm.
in the private markets, especially on the equity
Yeah.
side, where you have shown, I think, as we all see, that some of that underperformance in the last few quarters, in the last year, is due to the adjustment of valuations, which is really
Hmm.
due to the discount rate factor and the
Hmm.
increase in discount rates. I think we continue to see this effect in the market from a GP perspective.
Mm.
And
Mm.
if many investors were perhaps hoping for the tides to pass, clearly the latest inflation measures do raise an eyebrow on that. We may still
Mm.
see weak valuations going forward, which do remain somehow a concern. That's why in the market we see a little bit of a weaker fundraising environment and to
Mm.
some
Mm.
extent more caution. But I will
Mm.
perhaps come to why this still could represent to some extent an opportunities. You pointed
Mm.
out at renewables improving performance. That's something we've
Mm.
also observed in the market, and it's largely because,
Right.
I would say, of power prices that have
Mm.
remained
Mm.
elevated. At least that's our
Yeah.
interpretation. If you were to look at PPAs, both in North America and Europe, you would
Mm.
continue to say a steady increase in PPA prices, particularly in Europe over North America. But
Mm.
the renewables market remains challenged. We all
Mm.
know and have clearly
Yeah.
in our minds what has happened recently in North America with the executive orders,
Yeah.
which are providing some headwinds. And we've also seen
Mm.
a number of listed companies on the renewable side having a little bit more of
Mm.
a challenging period, especially
Mm.
when it comes to offshore wind in North America. Your presentation could, however, be more timely in the sense that being able to compare private equity and infrastructure at the moment and look at factor exposures is
Mm.
very, very important. Let me explain why. Anecdotally, if you think about the fact that listed equities have really had a strong run in the last year,
Mm.
our perspective is that many LPs today face a situation where they are overexposed to listed equities and they
Yeah.
need to rotate capital from there. And most
Mm.
likely, they will look at finding opportunities with strong return
Mm.
proposition. And that will indeed be most likely infrastructure and private equity alternatives in general. That's what we're seeing in the market. And also if you're slightly
Definitely.
analyzing fundraising.
I mean, we
Um,
see that, right? Over a 10-year basis, the private 2000 has a much higher return as opposed to stock market. So it's a temporary thing. This last year's performance. Yeah.
Exactly. I agree. And it's really interesting that beyond the pricing element and the valuation element, what you're seeing right now is a change in the market structure
Mm.
in the
Mm.
sense that many investors are thinking sectors, private equity, infrastructure, real estate, but at the same time, they're thinking themes and factor
Right.
exposures, meaning
Yeah.
that you start seeing an overlap between what private equity managers and infrastructure managers do when it comes more to the
Mm.
greenfield value add
Mm.
capital expansion
Mm.
space, and a
Mm.
bit of an overlap when it comes to think data centers, what real estate and infrastructure investors do.
Mm.
So it's very, very interesting to see that I think more investors are looking at capturing these exposures and understanding the overall exposure of their portfolio and trying really
Mm.
to be able to understand beyond private equity versus infrastructure what their portfolio
Mm.
exposures are. And
Mm.
I think it's very well aligned with the market opportunity as well, where you see, again, more new infrastructure sectors coming to the market that perhaps they have more of a P angle rather than an
Yeah.
infrastructure angle. So it's a broader market, and your lens helps us interpreting it, and interpreting also why I think some consolidation in the market has happened. And in particular, I think there is an element of private equity managers starting to buy infrastructure managers as they see that as an opportunity. One
Mm.
final
Mm.
word. on credit spreads. I think
mm,
what you have observed in the market is exactly what we see. So
mm,
tight
mm,
credit spreads, which are really conducive to a risk-on market environment. This is something that in the past has lasted, several quarters, and we expect the same to happen in the sense that
mm,
the underlying economy seems overall strong. So I think it's
mm,
a little bit counterintuitive in the sense that many investors have expected a recession in the US to happen. It hasn't really happened. And now you see the
mm,
transition
mm.
matrices are really showing that the credit environment is supportive and risk is reducing. So it is something that, it's interesting to observe. It's definitely backed by numbers, but very different from the overall expectations of
Yeah.
investors in the market, which brings me really to the last point, which is while in 2023 we were talking about take privates, because to some extent private valuations, you have shown it, were really still adjusting, but listed markets were coming from a much weaker performance. Today you
Mm,
actually see an
mm,
environment, and I'll conclude, I think, with the observation I made at the beginning, where actually that exuberance on the listed markets and that diligence in the private markets may potentially spark some opportunities for taking some assets listed to create value.
mm.
That's a question mark. That's something we may see, we may observe in 2025, cannot be excluded given where markets are and where they're
Yeah.
positioned for.
Yeah. Yeah. Thank you, Gianluca, and I completely agree with these points that you have raised. We have a couple of questions. Let's try to get into that. Though, do you have also looked at the EV/EBITDA prices for infra compared to public equities? Or do you think that is a bad KPI to compare and rely more on risk premia, etc.? So I think from our point of view, we do compute EV/EBITDA. So at the moment, we are looking at on average for global infrastructure market about 11 to 12x EV/EBITDA multiple. But comparison with public equities is it's not really fair because infrastructure is very different from the listed infrastructure company that you find. There are a lot of significant differences in the underlying universe itself. So that comparison is less obvious as opposed to the private equities comparison that I make here, which is also different. They're not underlying the underlying universe is not the same, but it's still a better proxy to compare against as opposed to infrastructure. That's my view. Gianluca, do you have anything to add here? How do you look at infrastructure versus listed markets?
Abhishek, I agree with you. I think you recently published a paper where you on alpha and private markets where you're stretching the importance of size. And
Yeah.
I think that's exactly one of the factors that makes the listed universe different from the private universe. But hey, look, what I've learned working for an LP is that ultimately it comes down to your strategy. Some LPs see listed and private as separate buckets, and you have actually different teams investing in it. Some LPs do actually look at listed as part of their private strategy to be opportunistic in the market and to have differentiation and diversification when it comes to exposure. So they deliberately use the difference to diversify that portfolio. If your objective is timing the market today or trying to be opportunistic, I think what we are seeing is that if you're looking at growth, that's probably not the best ideas. If you're looking at income, there are many
Mm,
listed
mm,
opportunities there that provide really attractive entry returns and haven't really bounced back on the listed side. Think REITs, for example, in the UK. And there may be an opportunity there to see relative value over private markets.
mm. The second question in sorry, I missed that part. That do you think it's a bad KPI to compare and rely on more on risk premium, etc.? Um, I think that multiples in general in infrastructure are difficult to compare because of their nature of having a finite life, because these are project finance companies typically contracted for a certain period. So comparing multiples is not as obvious as comparing risk premium. Risk premium you can use to build a DCF type valuation approach, and it's a better comparison against another company as opposed to EV/EBITDA, which takes away that element that what life is left for that business, and accordingly, EV/EBITDA might be even lower because the remaining life is much smaller for a project as opposed to a newer project which has a far bigger life ahead of it. So at least that's my view, that risk premium is a better comparison in infrastructure. In private equities, obviously, EV/EBITDA multiple is the king. So people tend to look at EV/EBITDA multiples a lot more. Second question we had was, can you remind us the sample of the analysis and how you got Q4 data, as they're not totally available? Right. So this is this is the best part of private metrics indices, right? That we measure these valuations based on observed transactions, but all the financials, all the models, the estimates, the valuation estimates, they are in-house developed by us based on those observed transactions. So while if you are relying on manager reports, etc., it may not be available for Q4. We have an approach that we use to model these valuations every month as soon as they are available, the data. And we also take into account the macroeconomic data, so interest rates, FX movements, everything, to get to the valuation estimates. And that's why we are able to produce this Q4 results to you. In terms of the sample, on the private equity side, we actually have almost 100,000 companies, in fact, even more. In infrastructure, we have about 800 companies that go into our universe. So a very wide sample overall to come up with these global market-based trends in performance. We have a few more minutes. If there are any other questions for me or for Gianluca, we'll be happy to answer. You can either put this in the Q&A box or raise your hand, and you can just ask us. No? All right. Then I thank you for your attention, and thank you, Gianluca, for your comments.
Yeah.
It's always a pleasure to be presenting with you, and hope to see you again. And for all the attendees, we do these Blitzinars every week. Next week, we are going to talk a little bit more about market risk and alpha. Please do look out for the meeting invite, and I hope to see you again next week. Thank you. Bye-bye.